Volume price trend, often called VPT, is a technical indicator that combines price movement and trading volume to help describe the strength of a market trend. It rises when price increases on strong volume and falls when price declines on strong volume. Traders use it to confirm whether a price move has real participation behind it or whether the move may be weak and temporary. One of the main strengths of VPT is that it links price and volume in a simple way. This makes it useful for confirming breakouts, trend continuations, and reversals. When price and VPT move in the same direction, the trend may be healthy. When they diverge, such as price making new highs while VPT fails to follow, the market may be losing momentum. This can give early warning before a trend weakens. VPT is also flexible. It can be used on different time frames and with many asset classes, including stocks, indices, and commodities. It helps traders understand whether buying or selling pressure is supported by participation. For those who prefer trend analysis, it can add an extra layer of evidence beyond price alone. However, VPT also has important limitations. It does not give clear buy or sell signals by itself. Because it is a cumulative indicator, it can be slow to react and may stay positive or negative for long periods. It can also produce misleading signals during choppy or low-volume markets, where price changes do not reflect strong conviction. Another limitation is that VPT depends on reliable volume data. In some markets, especially those with uneven liquidity, the volume information may be incomplete or less meaningful. VPT can also be interpreted differently depending on the trader's style, which means it requires context and confirmation from other indicators or chart patterns. In practice, VPT works best as a supporting tool rather than a standalone system. Its value lies in helping traders judge whether price movement is being confirmed by volume. Its weakness lies in the fact that it cannot predict the future on its own and may lag in fast-moving markets. Used with other methods, it can improve confidence in market analysis, but used alone, it can lead to false certainty.